start now. So, hello everyone. I hope you're all doing well. Um, so we're gonna cover uh, different topics today now. Um, I hope the previous session was helpful. So first, if like you have just joined or like you cannot access the chat, just join or like see the QR codes here and you can scan. So the notebook that we'll be using today, the first one is features engineering notebook. So that's here. Then the attendance form is in the center and board interest form that I'll be talking a little about is on the right. You can take like a picture of it. Just give 10 seconds. All right. So yeah, I hope like the last session with the WorldCon gave you some enthusiasm towards like alphas and like trading in general. Um, so quick announcements. Quiz 4 was released on Sunday. Um, Quiz 5 will be released today or like as soon as possible. And it will be based more on the today's content because week 5 was nothing such covered because of the WorldCon. So quiz 5 and 6 will be mostly based on today's content. And then both will be due on May 14th. So the quiz 4 and 5 are due on May 14th so that we are on track of the quizzes. Um, and then uh, we'll release the board positions. I mean, I already gave you the QR code. I'll also give it on Discord. You can find the link to it in the link tree of us. So please do that. And I mean, just one thing that we encourage at TQT is that you must have like a genuine interest and devotion in contributing to the community if you are applying for the board. Um, it's not about uh, like having very in-depth experience with quant. It's a new initiative, so you will learn as we progress, but some interest and uh, uh, insight into it, or you have the devotion to like actually help others grow here. That's the thing we ask for. And obviously, in such settings, you should have like a very collaborative attitude, not like dominating or any other attitudes that you know what I'm talking about. So please, if you think that you might not be a good fit for such a setting, you should not apply. I do encourage everyone here who have been in CSE 198. You are a great set of people who have much of experience through this class, and so please try to see if you can make the course or the initiatives we take even more impactful by being on the board. So benefits is obviously you are being on the fastest growing student org. You have seen our growth in the past, and I hope that was helpful to you as well. Uh, and obviously we have a very good network currently, like we are at the peak of what we expected to be. So we have a very good network among industry professors and all the departments. So if you are on the board, you have that network as well. Um, and then for quant industry, like specifically, you have seen WorldCon giving a session. They only value skills and profile, right? Like this is one industry where like no such restrictions or like there are very less than other companies on um, which nationality you are, which ethnic group, or like diversity hiring. All those things are secondary. The first thing that matters is skills and profile. So if you are a part of this group, you're probably like in among the people who are well fit for quant, right? So so do our activities also. Like we have been trying to mostly focus on technical sessions. As you have seen in like past 1 year, like we almost had zero socials like as part of TQT, and that's the thing. Like I mostly consider like skills and technical sessions more helpful to the people who are joining this org, but it's not like something restrictive, right? Like it might be something that's a drawback of me or the TQT board currently this. So be the change you wish to see in the world, right? Like if you want to see a change, you want to do something different that we have done in the past, you are very welcome to do it. We're welcome to propose it and being on the board and lead it. So be the change and try to apply to such positions where you can make the change, right? So please do uh, see the descriptions that I have written in the board positions. Mostly you need to be at least committing for 2 quarters, and other specific descriptions are there in the form. I'll quickly share back like the the QR codes so you can scan it. Um, I'll put the notebook again. So this was, oh, should send everyone. So this is a notebook. Um, this is the attendance form, and this is the board applications. Okay. So so that was from my side. Any doubts? I think someone was trying to say something and I muted. Anyone? All right. Uh, okay. So, I mean, I just want to give like kudos to the team that have been helping build this like TQT in general and CSE1 and T8 specifically. Um, Anya and Megha are our VP internals. They contribute in like giving you lectures, making quizzes. Joanna is our designer who designs all the posters you have seen in the past. With Sophia, um, and Varun and Piyush have been helping in the logistics of this class as well. And as part of what they have done other initiatives, and then me as well. So this is like the team you can expect to see even next year, except Anya might graduate earlier. But we'll be there and you can expect to work with us in the next year. So one thing, just like quick thing, there is a CSE Student Awards nomination currently going on. If you have like anyone, like including us, to be nominated for a student award, it would be very much appreciated if you can fill out that small form. You just have to like write one paragraph about how the activities you have seen here in like TQT or any other student has helped you, right? Like you might be involved in some other orgs. That's also a good thing. Like if you were impacted by some person in a CS like department, then fill out the nomination. I'm particularly applying for the Alice Wu Memorial, whatever. I mean, like you have the opportunity to like make the nomination for anyone. So all right, so we'll just go now to the features engineering uh, notebook. So like when I say features engineering, what does it mean in terms of quant trading is you want to develop features that helps you make trading signals, right? uh, in our worldcon also, like we have seen alphas, they have specific features they are considering, right? Sometimes they are considering sales, assets, um, other indicators, right? So when you get the data of any stock, you don't get that indicator in the data, right? You have to build it. So WorldCon directly gives you that data, but in real world, you don't really have those, right? So how would I do like build some features from scratch using any data. So this is about like building data and how they can be used, and what's the like insight into building those uh, specific indicators, right? So how they can be actually used in generating some signals. So let's go over this. I'll run uh, live the code, but if you see any like problem in running it at your own uh, computer, please let me know, like discuss in the chat so that like others can also be helped. Uh, so firstly, we'll just like import all the libraries that we'll be using. It's not something like too out of the known libraries. The only thing is the Yahoo Finance library that's useful for getting the data itself, the stock data. So that's first. And then you have this one more library called TALib. TALib is like short form for Technical Analysis Library. So on Google Colab, to import this, like you have to do some kind of like package adjustments. So I've just found it out through like online other portals. Took me a while to like figure out what's the wrong part for it. So uh, try to run this. I hope this works. Like if you just do import TALib as TA, it might not work, but usually that's the way you do it. So uh, try to do it here. And then what I'm going to do is I'll create a data frame. So the way to do it is just df equals Yahoo Finance download Google. So I'm downloading Google's stock data. And you will see the data frame, like some few rows of it. And the data we have here is open, high, low, close, adjacent close, and volume, adjusted close. So I'll talk about adjusted close price. It's the stock's value after accounting for like any corporate actions taken, right? So these generally include like dividends or stock splits that happen during a day. So let's say uh, Qualcomm declared to give 1% dividend to everyone. So that would impact its value, right? So you have to adjust it, and it will make the close price a little different from it is currently. Usually you will see it equal, right? That's like a very uh, like rare thing that would happen, that like, oh, dividends were given like during the trading time, or like stock split happened. So uh, as in stock splits happen when you want to make it more affordable for people to buy the stock. Like one stock is running at like $500, so like buying the one stock of it involves $500, which is too much. So like company might decide to split it into 10, so that would be like a $50 each share. So that would impact its close price, right? So adjusted close price uh, considers that. So we will like eventually use adjusted close price, and it's very similar to close price. So now what we're gonna do is we will add specific features as described here. First is variance 10. So percentage change in the close price over last 10 days. Okay. So that is the variance for 10 days, and variance for 200 days. So that's like a long-term variance, right? And again, we'll see the rolling correlation between these two. So if you remember, like even while building one of the alphas, we were trying to see like if the moving averages of a long-term like long-term data was more or less than short-term. So that's the similar idea here. We are trying to see how the variance is changing in short term relative to a longer term. So what I'm gonna do is I have taken n equals 10. It's like uh, so that I can give it a name, the column name variance 10. And PCT change is like a function called percentage change. So that would calculate how much percentage change happened in the last 10 days. Similarly for 200 days. And then what I will do, I will calculate moving correlation for these two, right? So um, that involves like a rolling average of 50 days. So we are taking it for a 50-day window. So every 50-day window, we'll calculate this and create the data. So it might be confusing on first seeing this, like why are these values suddenly NANs, right? So one basic thing is when you take variance of first 10 days, right, you will have null values for the first uh, 9 positions, right? And on the 10th day, you have the past 10 days data, right? So then you can like actually have a value. So the first time this column variance 10 value becomes some number which is not null is at the 10th index, right? So that's the place where this becomes non-null. Similarly for 200, right? It would become non-null at 200. So those were those two. Now the question is when the moving correlation becomes non-zero. So the moving correlation we have taken is for 50 days, right? So this variance 200 became non-null after 200 days, and then you're taking it, the moving correlation for 50 days. So then you should add it and then get the correlation. So moving correlation becomes non-null at the 249th index. So now like at this point you can see every uh, column has a value at this point, right? At the index 249. And after this, everyone will have some value. So eventually we'll see like rows like these. Okay. So now that was about like three uh, features that we added, right? We added three features: variance of 10 days, variance of 200 days, and the moving correlation for a 50-day window. Now, let's talk about like how we can use other features. So a doji is like uh, a term coined in Japan used for uh, creating like open and close price for a stock when they are very same. So if you remember our candlestick charts from like lecture 1 itself, we talked about these symbols where the lines represent how high the stock went. So this part here is the high price on the top. On the left, you will have the open price. On the right, you will have close price. And on the down, you have the lowest price, right? So usually your uh, figure looks something like this, right? Let's say the stock went up. So this was your open uh, on the left. This was your close on the right. This was the highest it touched on the day, and this was the lowest it touched on that day, right? So this was the usual way you will see any uh, stick in the diagram, right? If this happened, this makes uh, look like your stock went higher eventually, like it's opened here and it went up by this amount. And if it's the other way around, like it would open at a higher price and went down to the close price. So those are like usual cases that you will see. But the special case here is when both open and close price are equal, right? So that has some information available that, okay, it did like trade high and low, but eventually it closed on the same price as it opened for. How does that help? So if you understood this, like this extra information is like you can have three kind of dojis. You can like see the description here: gravestone, long legged, and dragonfly. It's just dependent on uh, how was the variation here. So here you can see open and close price were very low, but it did trade very high in the day. This is like almost in the middle, and then here you have a very little high price, but the low price was significantly lower. So that's just like terminology, but what matters is the doji itself, like presence of candlestick which has open and close price same. So how to use doji? So you will see like charts like these when you like use any kind of investing portal, and then you can see right over here on the right, marked by a blue arrow, a doji, right? So that doji is a gravestone doji because the stick is going higher more, and that uh, indicates that there is a significant high volume uptrend, which would indicate a bearish reversal over the near term. What does that mean? So um, in the diagram, you can see that the stock was going uh, by the purple line, right? Or by the, so the 50th day average is that, and the 200 is that, right? So those two are like two graphs. And when you see this doji, that means a reversal in what's being currently going on, right? So if the stock was going like in a downward trend and you saw this doji, that means it might go up or the other way around. So I think here, the in this example, the gravestone doji would predict a further breakdown from the current levels, right? So because it was going little up, here the stock, you can see it was going up and this doji came, right? So this gravestone doji you can see here, and then uh, we would predict that the stock would go down. Why would this happen? It's because the fact that your open and close price have been the same, uh, but the stock is now set to reverse, right? So it's going up, but it's not going to go significantly up. It's just a momentum thing. So now your momentum has to go reverse. Um, so this is like a very commonly used like a strategy for day traders or even like short-term traders uh, that see any reversals and then they try to make like small profits out of this reversals. So if you remember, one of our strategy in like alphas was also based on reversion theory, right? Reversion theory was like your current upward or downward movement would reverse and like stock will come back to equilibrium. So this doji is like a symbol of equilibrium. Now you are like going back towards the equilibrium. Um, so that was about doji. Now how to use like the doji uh, concept we learned. So we'll make a feature for that also. um, and the way to do it is here. So price action patterns, what we'll do is we'll create like all the doji indices, and you can ignore the engulfing part right now, just focus on doji. So what we are doing is first assigning all the uh, we are assigning a doji column and giving it zeros, a bunch of zeros for now. And then whenever we see a doji which is going in a positive uptrend, we'll assign it +1, otherwise a -1. Okay, so like or I mean for now it just like if it's not zero, we'll assign it a index which can help us identify it. So not +1 -1, just like uh, not zero. So here we plot the dojis that we run above, and you can see like these were the red dots where dojis happened. Note that like this is very long data, right? It's 4 years of data. So these are not too many, right? These are like 1, 2 dots. I've just made the dots a little bigger so that you can actually see them. But these are like few trading signals that are occurring, and you can a little bit follow that. Okay, whenever doji came, this actually like turned in a opposite way than it was going before it, right? So here like you can see it was going above and then it fell down a little again, and so on, right? Like every time you can see it, it does occur, but there are anomalies also. Like it might be that the stock is like hit by some news that's like actually making loss for the company, and then it's gonna keep falling. So in that case the doji won't work because the stock is, even though like here you can see this doji came, it was going down, it's like still going very much down. So that was a time when like stock was hit by some worse news, right? So that is one part of uh, doji pattern. Now let's think about one another engulfing pattern that I talked here. So engulfing pattern is when one candle is like fully covered by the other one, right? So how first I just assigned a engulfing pattern, assigned all the zeros to it. Um, and then through this code, what I'm doing is making engulfing patterns of 1 and -1. So first, let's like see what are those. So engulfing means whenever your like previous candlestick is like entirely covered by the next one, right? So here you can see like this is entirely covering this one, or even if you see it from this line, you can see entirely covering. So engulfing means that you are seeing a pattern where it's gonna go bullish if it was a red one before and now it's a green one, right? So that means that the stock has changed its pattern, right? It was going down. Red means going down, right? Like it might have opened here and closed here, but now on the second day, like it opened here, but it's like going well above. So it's like engulfing the uh, loss it made in the previous day by like increasing much more. So this is a very bullish uh, news for the stock, right? So here you can see engulfing pattern for a bullish uh, stock, and the opposite would be bearish one. So it might have increased a little on the previous day, but eventually it broke down, right? Like it eventually made like a loss more than the previous like profit. So this means the stock is on a very bearish side as seen by traders. So let's like try to see how to find these. So like you can see bullish engulfing pattern. There was a downward trend. Whenever we saw this uh, candlestick fully covering the previous one, we can say that it's gonna reverse to the uptrend. So what did I do here in the code is I have shifted and seen that if the open and close price was like entirely inside the next interval, then you assign it +1. um, if it was the reverse way, like it was a bearish engulfing, you assign it -1. So that's what happening here. You can read more in the code by yourself. I have added like comments. So that would help you like find the indices where the engulfing is happening. So the first one is uh, bullish engulfing, right? +1, I'm assigning here +1. And the second one is the -1. So that's the bearish one. So after you run that, let's see how the pattern looks like. So bullish engulfing dates is where your engulfing was 1, and bearish is the dates where engulfing was -1. And what I'm doing is I'm just plotting like last 1,000 points of data so that like we can see it better. Last 1,000 also means like post COVID. So that's like a normal market. Um, so here you will see both green and red dots. Red means bearish, green means bullish. And this is a little better than what we have seen before, right? Because firstly, you can figure out where the pattern reversal of what type is happening, right? Because of the like bearish, bullish categorization. And also these are like very accurate. Like sometimes you have seen this. This was uh, a engulfing pattern. Here there was one engulfing pattern and so on. Like you can see those are actually mostly following peaks. So uh, these are good for prediction. I think I might have what's the color, switch the color. But anyways, like those are like engulfing patterns. The colors might have been opposite or something. Okay, so Any doubts up till like this point on the engulfing pattern or doji pattern? Okay, so this was about those uh, two patterns that we can build just as a feature. So now like you can see in the data field we would have dojis and also like all these added features that would help us in our uh, analysis, right? So these are like features building that we can do using stocks. So now like let's go towards technical analysis more. Um, there are two more terms that we can use. One is called resistance. So you might have heard about this, like whenever someone in like news channels say like, oh, this is like a resistance point of this stock. If it crosses this value, it is expected to grow, right? So like your stock is usually like going like this, but this is probably like its resistance, right? Every time it comes close to this value, uh, it is unable to cross it and just like falls down or come back to the equilibrium, stays around that point, right? So it is like a resistance point for it. It's not able to cross this. But if you see that it is crossing that value at some point, it probably means that, okay, now the stock is going to like actually increase. It has crossed its resistance. So that's uh a good indication of continued trend, right? So until now we were talking about reversions, right? Like uh, engulfing patterns or dojis, they were indicative of reversions, but resistance is indicative of continuation of what the current trend is. So here we will build that as one feature. Secondly, you can check like RSIs for like verifying other features that you have built and whatever conclusions you have made through them. So RSI is the relative strength index, mostly used in like conjunction with other features as well. And what it measures is how quickly traders are bidding the price of the security, right? Like how much movement is there in the stock because of the the current news. So it is on a scale of 0 to 100, and if we see that the reading is like 30 or below, then it indicates that stock is currently oversold. Oversold means people are like just selling it, not buying it much because of the current movement. While more in readings like 70 plus indicates it's overbought. So people are like heavily buying it, even though it's not capable of uh, like making those profits, right? So overbought category is like somewhere a good example is like Nvidia. They were overbought at some point because people were impressed more by its value than it's actually worth it. So that's like an example of overbought. It would have a very high RSI at that point. Oversold, oversold is the category it is right now in, right? Like people are just selling it more than what it actually values. So that's like a stock can hold oversold or overbought positions at different point of time, but uh, in a current time you can calculate RSI using the amount of uh, orders being placed on a stock. Okay, so those two things can be used as verification of what conclusions you are making from others as well. So let's do resistance. I mean, resistance is very easy. You just have to take like a max value from past n number of days. Here we are taking 150. So over past 150 days, what was the like maximum value? You can set that as a resistance point. RSI is just using a library, you can calculate RSI because that's dependent on the number of orders being placed and all that movements. So for that, you can just use the technical analysis library. So once we do this, we'll see the resistance added here in our column, as well as RSI. I think it's there somewhere. Okay, so once we plot this, you can see the how the resistance and RSI have varied. So resistance, you can see like has been almost above like all the points of time, and whenever it like actually crossed the resistance, right, like let's say here, it did increase a lot, right? So the resistance might have been crossed here, and then eventually your resistance value would also increase because you are taking like a 150-day max at each and every point. So now your like stock price is basically the resistance point because it's keeping to increase more than resistance. So you can see that that was a good indicator at like points like these, and also here, like somewhere in the previous plot also. RSI, I mean, it's not, I just over plotted so that you can see how it is varying, but this is like not indicative of stock price. It's a index between 0 and 100. So it won't like go beyond this point, this section. But what you can see is RSI was at its peak here, right? When you can see this was being bought heavily, you can see very high RSI, right? So it was like um, being considered very bullish by the traders, and it's fine, right? Like people can think of company's value more than what it is. So that was a good indicator or like good verification of what we were thinking. It's crossing the resistance, and it has a high RSI. So people are overbuying also, but it's still crossing the resistance. Probably it's a bullish market, and it did increase after that as well. So that's like things that you can see here. Also, like you can verify the opposite also. At this point, uh, the RSI was like about 30 or like below 40, and that indicates oversold category, right? So the stock did decrease eventually after that also. So these indicators are good. um, I would encourage like everyone to try simulating like uh, let's say you invested $1,000 and use like these indicators to make profit, right? So I mean, you already have all the data like created in this data frame. You have the resistance, you have the RSI, you have like all the dojis dates, engulfing dates. Now you can like use these to see if you can uh, find out how much profit you can make by using these strategies. It would be simple. Like if you see a doji, let's say I can create a condition. If I see a doji and it's a engulfing pattern or something like that, I would buy it. Um, and if I see resistance being crossed and RSI still being in like among 50s or below, then I should buy the stock because it's not currently overbought, but it has crossed this resistance. So I should take the move and buy the stock because RSI would eventually increase, the traders, all other traders would also buy. So you can make like those if conditions and try to see if you are making profit. I've included like some other code here as well on the target labeling things. So I'll just go over briefly about this and then you can like read more about it. So target labeling means you are labeling how much your target uh, is like a positive percentage increase or a negative by like 1 or -1, similar to what we did for engulfing. So here your task is little different. You are trying to see what the variations are in the the stock price itself. So it's like target variance 1, target variance 2, and we can use these classifications to see if uh, that the set of data we are using is within 33 or 67th percentile. So I'll go over this like in more detail probably next time. I'm giving you the code for now so that you can like try to like understand this concept a little more by reading first. But at least try to uh, like go over the features engineering part and see if it's helpful in actual trading, right? But this is like something that can be done in like markets that you usually invest in, right? Like if you see engulfing pattern, you see dojis, you can make investments accordingly. So that was about features engineering part. Any doubts in here? I would continue to next topic that was actually planned for this week. Okay, so now let's switch to the other good strategy we have uh, in in trading, and that's called co-integration. So co-integration suggests a long-term equilibrium between two stocks. So now, like until now, we were considering just one stock. It will revert to a movement, like revert to equilibrium, or it's like crossing its threshold. All those things we considered for one stock. Now we are considering two stocks relative to each other, right? And what stocks I'm considering relative to each other, those are very much linked to each other. So let's read this. Like you have two stocks, let's say X and Y, and they have an economic link. For example, Pepsi and Coca-Cola, they have very similar um, client base. All the products they make are similar. So you can expect that their earnings as well as stock movements should be similar, given there's no like specific to that one specific company, right? So the difference now in these prices of stocks, as we learned, is called spread. And this is very important, as I said from like first lecture itself. Spread is very important for any uh, stock movements. And here the spread is between two stocks, right? So let's say one stock is moving like this, one stock other than this one, which is similar to it, is moving like this. So the spread is this height change, but the spread is expected to remain constant, right? You would not have a spread which is out of value because these companies share the same kind of economic around their products, right? So the key idea here is that whenever there is a temporary divergence, the pair trade would would be to sell the outperforming stock. So the stock that has moved up more than what it should, you should sell that and buy the underperforming stock, right? So the stock that moved down. So you are making a bet that like the spread between the two stocks would eventually converge, right? By either one stock performing lower than it's currently doing, the one which overmoved, or the stock which is underperforming would perform better. So the spread should remain same. That's the key idea. Um, and not even same, like in higher scenarios, I'll go over later, is that you can see like a ratio of change. So let's say um, you always see like a spread being increased by some factor while you move. So while the stock is increasing, this was like $1, and then it's like keeping to increase by $1.25. That is also fine. That's also predictable, right? Because it's a linear predictable equation, and then you can use it. So let's see how to like use this idea in itself. So again, I'm just installing the libraries that I will use here. Um, this time we are using stats model as an important library for doing the calculations. So Firstly, again, we are downloading stock data by using this function. So this function would be used again and again over here in the next cell. Like I will just call for all these stocks that I have listed, I will import the data using the get data Yahoo, and the function involves three inputs. Tickers is the stock uh, ticker itself, like how the stock is represented in Yahoo data, start date and end date, right? So date format of those. So let's run this for all the companies listed, and it would take a little time. So eventually you will see some data frame like this, where you have data from 2015 to 2023 by end. So uh, all the trading days data you have here. And the columns are the companies, right? So closing prices are the values here, and the companies are the columns. So now let's see how we can do a co-integration. One thing that we have to find is the co-integration value. So we are creating a function for it. What the function does is it finds out the pair of stocks with a p-value less than a constant, right? So p-value is what? The value corresponding to how similar the stocks are, right? So um, all these stock pairs like are not actually correlated, right? We have to find the stocks which are actually correlated. Let's say like Pepsi and Coca-Cola, as I gave the example of, they should have a p-value that's less than some particular constant. So the lesser the value, like more they are related to each other. So p-value is like a way, like kind of a variance among your stock values. If it's going much higher than expected, these stocks are probably not correlated. Okay, so the idea here is for like each and every pair, so you'll have two for loops. You're taking the stock data, like prices, and calculating uh, the co-integration value. This can directly be done by calling this. Okay, so um, the score and the p-value is calculated when you use this coint function, and we return that as well as the pair uh, which which was considered here. So the S1 and S2 were the pairs. So this function is used when running for all the stocks here. So basically you will have NC2 amount of pairs comparison here. So Apple would be like correlated with Microsoft, Google, Amazon, so on, all of them. Then we'll find if it's matching with any other stock. The p-value threshold we are taking is 0.05. You can adjust this. The lower you make, the lesser number of stock pairs you'll get. Um, so this will take time because it has a lot of data to go over. It's taking all the data of like two stocks at a time and comparing it. So that's the for loop part here. It will take some time. And what we will do is finally assign all the scores, p-values and pairs into one frame where we can see what were the top like performing or like top pairs who are correlated. So in the next function, what we are doing is finding which one were the top like 20 pairs of uh, correlated stocks, right? So we are sorting it by the p-value and seeing if they are correlated. So here you can see um, stocks pair in based on p-values. The p-value, the smaller it is, the more correlated it is. The higher it goes, it's less correlated. So you can see Coca-Cola and Pepsi are, of course, in the list. That means they are indeed correlated or co-integrated. Um, and then there are others as well. Now, this can also be like a by chance thing that, okay, they are being co-integrated, they might not have the same product. So one example is like Google and Home Depot, probably they are not too much into same products, but still they have co-integration value, which is much less than 0.05. That means their stock movements are governed by same uh, dynamics, but not by like their same products. So we'll see how to like use this data itself and our own insight into how like we should consider a strategy uh, when taking like two pairs. So one thing here is another function called check for stationarity. That means um, the stock movement in the graph is actually like following what we expected to. So stationarity does mean what I explained before, right? Like your uh, spread is almost remaining constant, or it's like not moving beyond the expected values. So the p-value does help us do that. You can like read more about stationarity just by googling. It's like a more econometrics term, but here we are just using as a check. So now let's go and use like Google and Home Depot that I talked about. They have a very low p-value. So let's see like if it actually makes sense to use a trading strategy as described above. So what I'm gonna do now is whenever uh, okay, for this code, if I think that was below. Okay. Yeah, okay. So now we are like uh, calculating the scaling factors. So scaling factor, as I said, if you had two stocks performing similar to each other, but not of exact same spread, but a ratio is consistently maintained. So whenever this stock, let's say, grows by $1, the other one increases by 1.5. So that's a predicted value that we have seen from like the past data. And then we are saying that, okay, this is the scaling factor that if we use, then we can predict the spread in the stock. So this other stock is probably looking like something like this, right? So it is the spread is essentially increasing, but it's increasing at a known rate, right? It's increasing by like 1.5 slope. So we want to calculate that for Google and Home Depot. What's the scaling factor? So when you run this code, you'll get that scaling factor as 2. How did I do it? Again, just difference in the data as a series of Google and Home Depot, and I apply the Adfuller test. So Adfuller test gets you this p-value, um, and like I'll give probably a question on like quiz something for definition of this. So try to read about Adfuller test. I don't want to go into like math depth of it. It's a very simple thing. So you'll get a factor of 2 using the test we described, right? Basic math is just finding some slope which is the increase in spread. And we also find the lowest p value using this. Now, let's see how like currently our Adfuller test looks like. So you can see that this trend is actually like reverting to mean every time it goes up or it goes down. So like this means there is a reversion to equilibrium in the stocks, right? So the spread, if it goes beyond what it is expected, it is actually reverting to equilibrium. So Adfuller test helps you verify if your reversion is actually happening like in the past. So here you can see it was going down and then it actually went back, coming down, and like it's just oscillating between the equilibrium, right? So that means this does have a reversion like Google and Home Depot, although uh, the anomaly is very high, right? Like it went all the way down here and then came back. So it's not a very good reversion. Usually you should see something just like uh, very small amplitudes, but just because Google and Home Depot are not very much correlated, you have these very high oscillations. So um, now that we have done that, let's like create the data frame again just for these two so that we can use them for uh, like a trading strategy and seeing if we can make profit. So now we have this data to frame, same code as above, and we are doing like a start time from 2020 to 2021. So just like a year and a half of data. And uh, so this is the new data frame just for our Google and Home Depot. And now we'll generate buy and sell signals based on Z-score. So uh, your signal is not just whenever you see expected like a cross in expected spread, you will just buy, right? You want to have some like threshold on like how much did it give a strong signal for. So Z-score is here useful to find out if there is a very strong signal, right? So uh, if the stock just like if let's say the spread was expected to go like this trend and it just like varied a little like just like this, it is okay, right? You can only see those anomalies in regular days, but if it like went well above what it expected to be, that's the point where you should trade, right? So for doing that, you calculate a Z-score to see if that trade is actually way out of what the expected trend is. So buy signal is generated when a Z-score is between 1.5 and 2. This implies that the spread is significantly higher than its average, right? And this suggests that like one stock is undervalued relative to the first one. Opposite is the case for sell signal. Whenever you see like a very down movement in the spread, that indicates it's significantly lower than average, and so do the opposite. Okay, so same idea in the code here. What you are doing, you are calculating firstly rolling means for that both the Google and Home Depot data. Then you calculate standard deviation, and Z-score is then calculated using your mean divided by standard deviation. Um, and then you don't actually need those. You just need the signals from it. So once you have done that, you first plot like Z-scores. So this is like a very long code, but eventually you will see Z-scores here. Um, and so the Z-scores were like varying, like it started from 0, it went like -2. So this will give a trading signal here. This gave a trading signal here. Every time it's like beyond this 2 to -2 range, it's a signal for us to buy or sell accordingly. Okay. So here, like I have actually run a simulation to see how well the strategy performs, right? So whenever you see a signal from Z-score of buying, you should uh, that's indicated by an index of 1. Again, like same idea as engulfing. Whenever you want to buy, you make that value 1, and in the simulations, whenever you see 1, you will invest in the one stock and sell the other stock. So this is happening in the code currently. If you run this, you will see how much at each transaction you are making or losing. So at each transaction, what you are doing is uh, like probably you are buying one stock and selling one, right? That happens every time. You're not like making investment in just one. You are doing it simultaneously and opposite way. So buy one and sell one, right? So that's the strategy. So this is also commonly called arbitrage. Like you are expecting to see an arbitrage because you're buying one stock and selling one, so you're not giving money out of hand, right? You have just invested one money into the other one. So that is called statistical arbitrage. Uh, in this context, it is slightly something dependent on how good is your like p values, how good is your uh, choice of stocks. But yes, that's what you are expecting to see. You want a statistical arbitrage. So arbitrage means risk-free profit. So there is no risk involved because you have not invested money from your hand. You have bought one and sold one stock. So that's risk-free and you are expecting a profit. So uh, this is called statistical arbitrage in here. So every time you made a trade, you can see if it was beneficial or not. So I mean, it can be negative indicates that you made eventually a loss on that. Positive indicates you made a profit. So you will see big profits sometimes. Like the losses are generally less, and the profits are like much higher value. So eventually, with all the transactions that you made, you can see you made like a total hedged profit of 22.63. And I think that was on a very small amount of investment, probably like, uh, yeah, probably like 1,000 or 500 some dollars or 10,000. I don't exactly remember the amount, but in every trade, like I have set like how much you can invest in one trade so that like you just don't go uh, beyond like a limit. So this max transaction at a time is the value um, that gives you a limit in one time. So this is the fifth one. So fifth one is 5. So you can invest like maximum $5, like five stocks basically at a time. And then similarly like max shorting amount. And then S1 and S2 are the stocks. So here we considered Google and Home Depot. You can keep changing this. And we went for about like window of 60 days. So we are like analyzing 60 days of window and doing this. All right. So this is like a lot of code, and which is why I want to give you to like time to understand. We'll probably like continue more on this through other examples. So let's say like I take a random one, right? Like in the list you have seen, you probably won't see Verizon and AT&T, right? But I mean, if you just go by guts, they are very much in the same sector, uh, and they must have like a very high correlation if you uh, like think about it. But it's not like it's very high p value or like relative to others it's a very high p value. And if you try to run the same simulation for that, you will see that it actually made a loss. It actually made a loss of $3. So again, the same code, just we are changing it for the stocks now, Verizon and AT&T. Um, we'll find a p-value or p-value and scaling factor. Scaling factor is just one here. And then you can see if uh, how your data frame looks like for Verizon and AT&T, and you can see the model here. So the hedged profit here is like -3. That means you made a loss. Um, and you can also see this z-score plot. This plot here indicates that it wasn't really like a very good correlation. Like this whole region was basically like a positive value, right? So it's like a continued trend. It's not reverting to like zero frequently as it should. So it's not something that you can make arbitrage on. Now let's like take something that's given by both uh, our p-value calculations and our insight. So we know Walmart and Home Depot are serving like similar sector. They are doing like things which are which are used in home, like furniture, electronics, all those things. And so they are very much correlated, uh, as well as co-integrated by seeing, if you see this p-values plot, you can see Walmart and Home Depot were the second one with p-value 0.007. So pretty low p-value, that means highly co-integrated. So let's like run the same code now on that. Um, oh, data pool is not okay. I should have copied. Oh, I should have run it from here. Okay, so running it from here. So you'll find the optimal scaling factor again. Usually, uh, like it would be something that, I mean, it cannot be predicted. Like you saw 2 for the first example, 1 for the second one. Now it's like about 7, but still they are highly co-integrated. So let's see how like the profits are made out of this strategy. So here you can see, I mean, currently I've used a different date than previously used, but still I'm making like a profit of about $19 on this, based on the same strategy. So here you can see like reversions, even though there was like a huge peak, it was followed by a huge down, and then again peak, and then again. So like it did kind of oscillate a little. And these are the places where you actually make trade. Now note that like you're not against seeing like high moments. You actually want to see these out of phase moments so that you know that it's like a trading signal. So if it like remained just like around this point, you probably won't trade, right? Because it's like co-integrated, it's moving smoothly, nothing like crazy happened. But here, the points which are out of phase, these are the places where you are making trade, right? So these are of importance to us if we want to make statistical arbitrage. So um, these uh, like Z scores help you understand where you were like actually making trades. I think there was some date that I've changed, but you can see like I have made the profit of 34 on this based on the strategy in this date. So this was like a part of workshop if you have attended before, like some part of it I covered in a workshop. All right, so here like again we simply used stats model and linear regression from scikit-learn to see how like they can be used. I think actually end up not using linear regression because that wasn't required, so you can remove that. Um, but any confusion in like the existing code. So again, like just to reiterate, like these else if conditions are just for buying and selling. Like when you would buy, you would check if z score is greater than 1.5, less than 2, um, and you would make the buy signal equals 1. Again, we are checking one more thing is that we are checking between 1.5 and 2. That means if it's like going beyond 2, uh, that is a signal of like one company's uh, different sentiment than another, and it's like some specific news. So you don't want to trade in that risky zone. Like you would probably uh, consider a reversion when it's between these two values. And if it's going beyond 2, it's probably that okay, like Pepsi received some big contract, and so they are going to increase a lot more than what they usually do. So there you do not want to make a trade, right? So you can define this region. I have chose 1.5 to 2. You can choose others as well. But the reasoning behind the z-score region is that you want to minimize your risk while doing these trades. Okay. Any questions? Like, there was a lot of code involved in this lecture. I have tried to like include comments as well so that like you can go back and understand the code if I'm unable to like cover all of it. Uh, but it's mostly just if and else cases here that you have to think about. This optimal scaling factor uh, is the beta here, and I think that's what deferred the profit, because usually I think I have used one here. I don't know why I did it. I changed it here. So we got 7.18, so we should use that as the beta factor here. So let's add it and run it again. Okay, so yeah, now you see 33.8. That was I was mentioning. So that scaling factor is important. The scaling factor is the beta value uh, that you get from here. Um, and that is involved in the calculation when you make the trade. So when you want to calculate z-score, you are calculating using the beta as a factor. Here you can see the beta factor was taken into account. All right, so that's mostly about it. Any like questions from people? List options. All right. So yeah, like I'll just reiterate, like if you want to apply for the board positions, you are welcome to. And also um, I can share the QR code again if you didn't get the attendance, you didn't get the notebook. Also for the PS trading strategy, I think should share the code in chat. Sharing it in the chat so you can see. Um, and then I'll share in the Piazza as well the link to this. This is open to everyone. Yeah, and then yeah, you can like fill out nominations if you are willing to. If you found like activities by any student helpful to you. Okay. All right. Think that was it. We are ending like 5 minutes early now. Next class will be in person. So thanks for like joining remotely today. It will be in the CSE 1202, same time, same place. All right. Goodbye.